Persistently high mortgage rates, more than double those observed in 2020 and 2021, coupled with soaring home prices, have resulted in a stagnant housing market. People aren't buying houses like they used to. Existing home sales have plummeted to levels people haven't seen since the foreclosure crisis in 2010, while mortgage demand has sunk to unprecedented lows spanning over 2 decades. People's financial situations aren't faring any better either. Household debt, led by mortgages, credit cards, and student loans, recently surpassed $17 trillion. Inflation persists above the Federal Reserve's 2% target, and the looming possibility of a recession in 2024 adds to people's worries. Here's the big question. Is the housing market heading for a crash? Experts are already predicting a risk of downturn in real estate markets in Illinois, New Jersey, and California next year due to higher levels of foreclosures, unemployment, and underwater mortgages. Plus, experts predict home sales overall to be weak in the first half of the next year. They say activity should pick up in the second half and further into 2025. And that's primarily because affordability will improve. You gotta read in between the lines here though. They say affordability will improve. We say a housing market crash may be imminent. And honestly, this may actually be a good thing. If many investors end up selling their properties because of this, then it will let more prospective home buyers actually afford a house at the price that they're really worth, which could possibly be 50% off if we're really being honest. You know what I mean? We're already seeing some imminent foreclosures on the horizon. Actually, some of them due to some very questionable practices on the investors' ends. Check this out.
The glittering 188 West James Towers can be seen for miles in San Jose, and the luxury condo project created by ZNL Properties was once touted as an example of the city's prospering downtown. But tonight, it appears the project is falling apart. According to the Homeowners Association board, the Foster City-based developer is facing foreclosure for failing to pay years of monthly homeowners dues of $600 to $800 on more than 200 empty, unsold units. One resident we talked to says to save their homes, they held a special election to remove the 2 ZNL board members when ZNL refused to pay up.
A building of this size takes money to run, right? Even if we're just talking about electricity and water. And so my concerns is that we're not going to be able to make those payments with the money that is coming in from the residents that do live here.
I guess my former landlord was right. There is a big difference at the end of the day between investors and landlords. Landlords provide an economical, nice, clean living home for tenants. They always have quality tenants because they provide quality living conditions at an affordable price. Investors and slumlords are one and the same. Always worried about the profit, never a tenant. Not every investor or landlord has the mentality to do this job. Me? I say amen to that. What do you guys think? Just look at this headline. Invitation Homes forms build-to-rent team. You know these companies are setting up for something because it's like they're dropping hints that they're not too sure about the regular housing market. Just look at what they had to say here. It's impressive that we've organized in a way that enables us to scale using the full capabilities of our platform. Remember guys, real estate companies closely monitor market conditions, and if they're opting for build-to-rent properties, it could suggest a lack of confidence in the traditional home buying market. So there could be this perception that potential home buyers are becoming scarce, or that existing home owners are increasingly turning to rental options due to uncertainties in the housing market. They could also be seeing all the changing economic indicators turn for worse. If the company perceives economic instability, rising interest rates, or increasing levels of household debt, they may anticipate a reduced capacity of individuals to afford or qualify for mortgages. In such circumstances, renting could be a more attractive option for many. So for them, building rental properties may be considered a safer investment compared to traditional home sales. And it looks like they may be rushing this too. Invitation Homes said the changes will be in effect by the end of the year after a brief transition period. With these companies and all their business babble, you really got to know how to read in between the lines, am I right? And that's why you have me here, giving you the lowdowns and analysis, getting to the truth behind the headlines. So if you haven't done so yet, do consider subscribing to the channel and tapping that notification bell. That way you guys don't miss out. Not to mention, it definitely helps out the channel. Thank you guys so much for always checking out the videos and giving that oh so important thumbs up. You guys are the best. I appreciate that. Another headline to dissect here. California investors shed rental houses. It's a national trend too. So according to this, state by state, Census Bureau stats detailing who lives in single family residences, detached and attached, and whether occupants are owners or renters. Figures from 2022 and 2017 are compared. Now these figures show renter occupied single family housing is largely on the decline. California has the most single family rentals in the nation at 2.1 million units, or 15% of the US total. The vast majority of this housing is owned by small investors. Next in scope for this renter's option is Texas with 1.3 million units. Then there's Florida's 897,078 units, Pennsylvania's 602,495, and Ohio sitting at 584,589. But between 2017 and 2022, the number of California single-family rentals dropped by 81,548 units. That's the second largest dip among the states and 11% of the 742,000 decline nationwide. Now, compare that to owners who occupy their single-family residences. California ranked number 1 with 6.8 million owner-occupied homes in 2022, 9% of the US total. Next was Texas sitting at 6.3 million, Florida at 4.8 million, Pennsylvania at 3.4 million, and New York at 3.2 million. And California added 400,768 owners of single-family residences in the past 5 years. That gain equaled 6% of the 7.2 million US increase and ranked only behind Texas, up 873,038, and Florida up 771,406. When the economy was doing well, ignoring the whole pandemic mess and mortgage rates were dirt cheap up until early 2022, it pushed a bunch of Americans toward the idea of living in their own single-family homes. Plus, in the last 5 years leading up to 2022, U.S. home builders constructed around 4.8 million shiny brand new homes, with a chunk of them, 310,000 to be exact, right there in sunny California. So a buying rush plus residential investment headaches associated with the pandemic life appears to have convinced more landlords to sell their single-family rentals, statewide and nationally, compared to any wave of investors who were recent buyers. Add that as another reason there could be a major housing price cut to expect in 2024. Then of course there's millennials, one demographic that isn't necessarily setting its sights on the milestone of home ownership right away. In fact, more millennials are delaying the purchase of their first home. All sorts of reasons. Affordability, not married or no partner yet, high levels of student debt, tighter lending standards in the banks, and of course the lure of bright lights as millennials continue to flock to cities in large numbers. But hey, if you're considering real estate investing, even if you're a millennial, don't knock off the idea of being a landlord. There is something to it. As a landlord, even if your property taxes and insurance go up, you can claim it on your income profit taxes. So many people are poor because they don't understand that the rich pay less taxes, not because they're putting their money in offshore bank accounts, but because they have a good accountant, a CPA, a tax advisor, in fact, even tax strategists. If you don't have an exceptional accountant, you can still figure it out on your own if you do your own research. Now, as for predictions for where the housing market's going to go in 2024, experts say that the combination of high mortgage rates, inflated home values, and scarce inventory suggests that 2024 could remain a challenging year for the housing market. As experts point out, with mortgage rates at their highest level since the early 2000s and affordability at a record low, many potential homebuyers are priced out of the market or unwilling to buy a home in fears of home price declines. Heading into the new year, home prices remain the same general range as they were at the year's start, with a national median list price of $411,000, just a bit up from $400,000 in January 2023. Meanwhile, there are some signs that show some future easing in the housing market. Housing inventory rose 7.5% year over year in November. More homes on the market could create more competition for sellers and potentially drive home prices downward. Economists for Morgan Stanley expect home sales to be weak in the first half of next year, but activity is expected to pick up in the second half and further into 2024, and that's primarily because affordability is expected to improve. They also think home building activity will be stronger in the second half of next year, meaning home prices should see modest declines as growth and inventory offsets the increase in demand. And by 2025, with lower rates, sky's the limit as existing home sales should rise more convincingly. Likewise, Realtor.com sees home prices beginning to decline in 2024, falling 1.7% over the year. Some helpful factors that they're looking forward to. The return to pricing in line with financing costs will begin in 2024, and home prices, mortgage rates, and income growth will each contribute to the improvement. Overall, they're expecting home prices to ease slightly, dropping less than 2% for the year on average. Already, they named 3 states that could see a housing market crash next year. Yep, that's right. Real estate markets in Illinois, New Jersey and California are at risk of downturn next year due to higher levels of foreclosures, unemployment, and underwater mortgages. They're counting as many as 50 counties in areas like Chicago, New York City, Fresno, and more that show the most vulnerability based on the portion of mortgage balances that exceed the value of the homes, average local wages required for home ownership expenses, and local unemployment rates. What they're seeing? Rapid escalation of prices during the pandemic, a general shortage of housing, increased demand for larger living spaces as families adapted to remote work and schooling, and an uptick in investment activity in the residential real estate market. All probable root causes for the current housing market vulnerabilities. So here's the deal. Economists and those real estate market experts can predict where they think home prices might go by looking at indicators to make educated projections for the future of home prices. But we have to remember, the housing market can switch gears pretty quickly. It's kind of like a roller coaster, you know? Keep your eyes peeled for stuff like housing inventory, new housing construction, and overall economic conditions in your area. So how many houses are being put up for sale, new ones getting built, and what's happening with the economy in your neck of the woods? And oh, don't forget about mortgage rates. They're a big deal. Even if home prices decide to go down, many experts anticipate rates to stay elevated for the foreseeable future. They call it settling into a new norm for the long term when it comes to interest rates. And that's going to shape how people think about getting into a mortgage. What am I saying here? Basically, buckle up for the ride, guys. And as always, I'll be right there beside you in this crazy housing market. Make sure you always watch our videos for the latest information. I look forward to seeing you guys on the next one.